Afternoon, everyone. Welcome to RCI Pod number 25. May I invite Joel to give the opening remarks? Over to you, Joel.
Thanks, Roger. Apologies for the delay. I was running from another meeting, only metaphorically, of course, but from another meeting all the same. Hello and welcome to the 25th series of the RCI-POD. Today's webinar will present a new financial inclusion index and empirical findings based on a joint paper by Sinyum Park and Roger Mercado, both from our Regional Cooperation and Integration Division of ERCD. In their latest paper, the authors find that financial inclusion has significant impact on poverty reduction and related socioeconomic outcomes, although the impact varies across different dimensions and country income groups. Financial inclusion allows access to useful and affordable financial products and services that meet the needs of individuals. Accordingly, understanding the dimensions of financial inclusion and their impacts on poverty, income inequality, women's empowerment, and entrepreneurship remains a relevant policy discussion. Cross-country assessment of financial inclusion impacts also underscores the importance of country-specific economic conditions and development levels in considering the effectiveness of financial inclusion in achieving poverty reduction. Today's RCI Pod will discuss these topics in depth. An expert panel is invited to discuss relevant policy issues. With us today are Peter Morgan, who is Senior Consulting Economist and Vice Chair of the Research of Asian Development Bank Institute. So welcome, Peter. And Mandira Sarma, who is an Associate Professor in the Center of International Trade and Development at Jawaharlal Nehru University. So welcome, Professor Sarma. Peter has written extensively on financial inclusion and its impact on financial stability, and Mandira has also written extensively on financial inclusion, measurement, and economic development. So my colleague Sinyum Park will moderate the panel discussion. So may I take the opportunity to thank all of our speakers and organizers of today's webinar and all of you for joining us today. So now let me turn it back over to Roger to present the joint paper on understanding financial inclusion, what matters and how it matters. Thank you very much.
Thank you very much, Joel, for that opening remarks. May I first share my slide to everyone? Okay. Okay, I hope my slides are on now. So good afternoon, everyone, and thank you for joining us today. I'll be presenting a co-authored paper with Sinyum Park entitled Understanding Financial Inclusion, What Matters and How It Matters. Just to provide some motivation, so economic literature will show that financial inclusion leads to better socioeconomic outcomes. It lowers poverty and income inequality. It leads to higher women empowerment and entrepreneurship. In this paper, what we do is we show that the significance of financial inclusion and its dimensions on socioeconomic outcomes differ across country income groups. So this would have an implication that the level of economic development of economies are important in order for financial inclusion to be effective in improving economic outcomes. In this paper, we have three main innovations. The first one is, aside from the traditional usage and access dimension, we also incorporate fintech infrastructure dimension as well as financial development dimension in our financial inclusion index. For fintech infrastructure dimension, we are trying to capture the physical infrastructure that supports digital financial services. For financial development, we are trying to capture financial efficiency as well as financial depth. The second key innovation of this paper is we account for the domestic structural factors in our financial inclusion index. So here we derive a term called effective financial inclusion, where we take into account domestic structural factors. Then finally, another innovation of this paper, as compared to other papers that has looked into the impact of financial inclusion and its dimensions, here we try to look into differences across country income groups. So the focus of this paper on the dimension addresses which financial aspect matter, while considering country income group will imply how these dimensions matter. To further provide some motivation, Figure 1 presents Financial Possibility Frontier. It is adopted from a paper by Barajas and co-authors. Here, on the x-axis here in Figure 1, it shows structural factors, whereas in the y-axis, we have the level of financial inclusion. So we can consider, let's say, two economies, economy A and economy B. Both would have two different structural factors. So for instance, economy A can be a low-income economy with a highly dispersed population, whereas economy B will be high income with highly dense population. So given the differences in structural factors of economies A and B, this will give rise to different levels of financial inclusion. In Figure 2, we try to show um, um, how economies actually, how differences in financial inclusion can lead to different economic outcomes. So for instance, consider an economy with financial frictions and no financial inclusion. There would be some proportion of agents in that economy that will be entrepreneurs. There will be some proportion that would be workers. Now, given an increase or improvement in financial inclusion and a removal of financial friction, then we can expect the share of entrepreneurs in the economy to increase, while the share of workers in the economy to decrease. As such, this would lead to higher economic output, higher income level, and hence will lower poverty in the economy. So here, overall, the Figure 1 shows why economies differ in terms of their level of financial inclusion, while Figure 2 will tell us how financial inclusion can have impact on economic outcomes. In our paper, we compute a new financial inclusion index using with 4-dimension indicators, particularly access, financial development, usage, and fintech infrastructure. So for financial development, for instance, we include indicators such as ease of getting credit, bank concentration, financial system deposits, and depth of credit information. While for fintech infrastructure, we include the share of population with electronic and digital payments, fixed broadband and mobile cellular subscriptions, number of secured internet servers, and share of population that pays bills or buys something online, as well as internet bandwidth per internet users. So given these different indicators per dimension, what we do is we take the unweighted average of each indicator to come up with a dimensions index. And then at the second stage, we use principal component analysis to derive the aggregate or composite financial inclusion index. We source our data from various database, and our data set includes around 153 advanced, emerging, and developing economies from 2011 to 2019. For socioeconomic variables, we consider poverty, headcount ratio, income inequality. We use Gini index. For women empowerment, we use a composite index reflecting inequality between men and women in terms of health, political empowerment, and labor market participation. And lastly, we also consider entrepreneurship, which is the number of business registration per population, and it's taken from World Bank Entrepreneurship Survey. So to provide some stylized facts on our computed financial inclusion indicators with new dimensions, Figure 3 shows the financial inclusion across different income groups. And as expected, the level of financial inclusion is significantly high for high-income economies, while it is very low for low-income economies. But what is striking for Figure 3 is that the level of financial inclusion for low-income economies has significantly increased in 2017. And even for middle income economies, whether they be high middle income or low middle income, we note a sustained increase in the level of financial inclusion for these income groups. In Figure 4, we try to differentiate financial inclusion across different geographic regions. And among the regions, we note that Europe has the highest level of financial inclusion, followed by Asia and the Pacific, and then Americas, which would include North, Central, and South America. Now, both Middle East and North Africa and Sub-Sahara Africa have very low levels of financial inclusion, but we may note that for Sub-Sahara Africa, the level of financial inclusion has in fact increased in 2017. To provide some more stylized facts on the relationship between financial inclusion and other indicators or other parameters that we are considering in our study, in Figure 5, we show that higher levels of of per capita income, economies will tend to have high levels of financial inclusion. In Figure 6, economies with high levels of financial inclusion tends to have low levels of poverty, whereas those with low levels of financial inclusion have high levels of poverty. For income inequality, as presented in Figure 7, we don't see any distinct pattern between financial inclusion and income inequality. For women empowerment, we see that economies with high levels of financial inclusion tends to have high levels of women empowerment, whereas for entrepreneurship, we find that those with high levels of financial inclusion also tends to have high levels of entrepreneurship. And the variation across countries tends to be higher for economies that have higher levels of financial inclusion. So aside from that, from including new dimensions in our financial inclusion index, another key innovation of our paper is that we try to incorporate domestic structural factors such as the economic level of economic development and financial constraint in our financial inclusion index. So the way we do this is that we, based on our computed financial integration index, we regress it on income level, education attainment, demographic structure, and other measures of financial constraints such as collateral, access, and efficiency. And after we've done the regression, what we do is we then generate the predicted linear values, and we call that predicted linear values from that regression as the effective financial inclusion. So basically what we're doing is we're trying to adjust the level of financial inclusion we have computed to some domestic structural factors. So let's take the case of Kenya, which is presented in Figure 10. In Kenya, our computed financial inclusion index would indicate that it has around 60 or 61 in the x-axis. Whereas when we already consider effective financial inclusion, this level significantly goes down at around 38 or 37. And this is in contrast with the case of, let's say, Qatar, which is at a high level of financial inclusion around 60. But when we consider other structural factors or economic level of economic development, then it registers or reports a very high level of effective financial inclusion at around 89 or 90. So in our subsequent analysis, we use this effective financial inclusion, including our 4 dimensions that we have computed. So we did the same for the 4 different dimensions: access, usage, fintech infrastructure, as well as level of financial development. We then extract the linear predicted values and use that to assess their impact on socioeconomic outcomes. Okay, so for our key findings, first, in Figure 11, we show financial inclusion and its impact on socioeconomic outcomes. May I mention that these are the estimated coefficients for our parameter of interest, but we also included other regressors in our analysis. And our empirical analysis specification is based on a panel regression with the economy fixed effects, clustered standard errors. And we have also included different regressors depending on different socioeconomic outcomes that we are considering. we looked into the different regressors based on the literature. But here in figure 11, we are just highlighting the results or the estimated coefficients for financial inclusion, effective financial inclusion, and it's also different dimensions. So for in figure 11, we see that an increase in effective financial inclusion, access, development, usage, and infrastructure leads to significantly lower poverty. Whereas for income inequality, we see that financial inclusion, access, and infrastructure are significant. For entrepreneurship, we see that financial inclusion, access, and usage and infrastructure are the significant dimensions of financial inclusion. So the key takeaway for figure 1 is that the impact of financial inclusion on a socioeconomic outcome, it differs across different socioeconomic outcomes, as well as it differs across different dimensions of financial inclusion. In figure 12, we present financial inclusion outcomes, but this time it is based on different income groups. So for instance, for poverty, we find that effective financial inclusion significantly reduces poverty for middle and low-income economies, whereas we do not find any significant impact for low-income economies as well as high-income economies. In the case of income inequality, we find that high and low middle income economies, effective financial inclusion reduces income inequality for high and low middle income economies, whereas it increases it for high income economies. We also note that one key result is that for effective financial inclusion tends to increase women empowerment and entrepreneurship, particularly for low income economies. Then we further extend our analysis by considering the significance of different dimensions across our 4 socioeconomic outcomes across different levels of income groups. One key finding that we see here is that for access, financial development, usage, fintech infrastructure, we find that these dimensions are insignificant in lowering poverty for high-income economies as well as for low-income economies. However, we do find that for high middle-income economies, these 4 dimensions are significant, whereas for low middle-income economies, access, financial development, fintech infrastructure are the relevant dimensions. So in short, what we can derive from these results is that the impacts of effective financial inclusion and its individual dimensions, they tend to vary across different country income groups. So as mentioned, for instance, for low-income economies, access, financial development, fintech infrastructure significantly lower poverty, but usage does not seem to have any significant effect. Another key finding that we would want to highlight is that access, financial development, usage, and fintech infrastructure, it tends to significantly increase women's empowerment, particularly for low-income economies. We further then extend our analysis by looking into the interaction between these different dimensions and financial inclusion itself, and interact that with income dummy variables for representing various country income groups. And what we find is that the impact for middle income economies, the impact of financial inclusion, access, financial development, and fintech infrastructure for that lowers poverty. It lowers poverty more for middle income economies compared to other income groups. What this then implies is that to reap the benefits of financial inclusion, economies might need to achieve some level of financial development in order to see a significant drop in the level of poverty. So that's one finding that we take from our results. Okay, so in terms of what are some of the policy considerations, Well, first is aside from considering both access and usage, in this paper we try to highlight the importance or the contribution of fintech infrastructure and financial development on financial inclusion. The second, the impact of financial inclusion varies depending on country income levels. So what this suggests is that the importance of country characteristics for effective policies to promote financial inclusion as a part of national development strategies. Lastly, another implication or consideration is that policies can then prioritize on some aspects or dimensions of financial inclusion. As shown in our results, there are some dimensions that are highly significant at a given level of economic development. And so in order for us to achieve a greater effect on socio-economic outcomes. So with that, I end my presentation there, and I look forward to any comments and through the discussions. Thank you very much, and I turn it over to Sinyang, who will moderate and introduce the panel of the panelists for this afternoon. Over to you, Sinyang.
Thank you, Roger. Well, we have two expert panelists who can, provide some comments and then also share some insights of the financial inclusion today. As Joe already introduced, we have Peter Morgan from Asia Development Bank Institute in Japan. Also, Professor Sarma, who's joining from India. Well, it's been really long time since I saw you. So thank you very much for joining us. As Roger presented, we try to really look at the diverse aspects of the financial inclusion, as well as what kind of country-specific conditions can make this financial inclusion more effective in a way. The financial inclusions do appear quite complex, and there are multiple aspects and multiple factors that contribute to the effectiveness of the financial inclusion. And then our study tried to investigate that kind of the differences across different factors that somehow seem to determine the effectiveness of the financial inclusion, and also how these can really be more, in terms of the policy, more effective, right? Because there's some what we also see even in the results that the effects of the financial inclusion are not necessarily linear. There are different factors that contributing to financial inclusion. Could be the enhancing element in maybe high income countries for certain socioeconomic the outcomes, but it may not be actually quite useful in a way to induce certain socioeconomic outcomes in some other countries. So we wanted to look at these different sort of interactions and the dynamics across different factors, and also the different levels of the country growth and then the development stages. So again, Peter and then Professor Sarma have done quite a lot of studies themselves. I kind of wanted to see if you have first any comments on the paper. Peter?
Yes, thanks very much. I very much enjoyed the paper. I found it a very comprehensive and rich discussion with some interesting contributions. So there are three main contributions, I think. First is they developed a new financial inclusion index, which incorporates additional measures of financial development, particularly financial development and fintech infrastructure. So it now has four components: access, usage, financial development, and fintech infrastructure. Then they calculated an effective financial inclusion index by regressing the calculated index on various macro level control variables, and then they estimated the effects of this effective financial index on various income countries according to the specific sub-indices. So my comments are first on the financial inclusion index itself. It does have a lot of components, so I think it's a little bit difficult to tease out which factors are most important, although they do some of this by looking at the four subcomponents. But I think there's perhaps a bit of a definitional issue. To what extent are these measures of financial inclusion, or are they measures of factors which could affect financial inclusion? Because if it's the latter, then I think presumably there are many more factors that could be included also. I would say that the inclusion of fintech infrastructure is a welcome dimension. It hasn't been covered much before. One thing that might be interesting to add is some measure of alternative finance platforms. In terms of the inclusion of financial development as a sub-index, I think it's conceptually somewhat different. So if it's being considered as a contributor to financial inclusion, then why not include other things too? Otherwise, I'm not quite sure why one would include financial development directly. There are some specific questions on classification. For example, should commercial bank deposits be considered as a measure of usage rather than access? And I would say there is very limited coverage in the indicators of SME finance. I think most of the indicators seem to relate to individual finance. In terms of the estimation of the effective financial index, I wasn't really sure about the rationale for that. It's not clear to me whether it's adding information or subtracting information. And I think that the example of Kenya was kind of interesting, where they had the index itself was quite high, but then when they applied the macro variables, it dropped quite significantly to 39. So, I mean, how do we interpret that? Certainly, Kenya has been touted as one of the success stories of financial inclusion because of the development of M-Pesa there. So that I wonder if that sort of kind of depreciates that development somewhat. The regression results were quite interesting. My main comment is that causality is, of course, very difficult to identify. It's easy to find correlations, and many of these development-related factors do tend to move together. So I think one has to be fairly careful about making inferences about causality. And finally, these are all national average figures, and so they don't necessarily shed much light on internal differentials, such as the differentials between the conditions in urban and rural areas, which can be quite significant in some cases. But I enjoyed the paper very much, and let me stop there.
Okay, thank you. Can I hear from Mandira first, and then maybe Roger can quickly respond.
Thank you very much. And first of all, thank you for giving me this opportunity to be in this webinar. And may I share my slides, because I have prepared some slides, because my comments are in more technical nature. Therefore, I think it would be more easy to convey the comments. So can you see the slides?
Yes, we can see the slide.
Yes, thank you so much. So the first comment is that I like this paper because it highlights the importance of considering financial inclusion coupled with conditions of economic development while assessing impact of financial inclusion on socioeconomic outcomes in like poverty and inequality reduction, empowerment of gender related aspects, and promotion of entrepreneurship. While doing so, the paper utilizes a conceptual framework from the literature and a whole lot of data from various sources, which makes the paper very, very rich in analysis. The results of the paper are quite interesting, and they highlight that economic conditions are important in the determination of how effective financial inclusion impacts socioeconomic outcomes. So having said that, I congratulate the authors and I find the paper very interesting, but I have a few comments on the methodology and methodological issues that I would like to dig a little bit more deeper. So to begin with, the 2 steps of the index of financial inclusion. In the first step, the authors consider 4 dimensions of financial inclusion, which have been already elaborated by the presenter, so I don't have to go into that. So dimension 1 is for access dimension, dimension 2 is for financial development, dimension 3 for usage, and dimension 4 for fintech infrastructure. Now in this step, each dimension has got various indicators, and then therefore a dimension index has been computed by using the average percentile rank of these indicators. And so let me call these dimension indexes D1, D2, D3, and D4. And in the step 2, a principal component analysis has been used to construct the index of financial inclusion, which is some kind of a weighted average of the 4 principal components. We have 4 dimensions, therefore we have 4 principal components, and each principal component has a variance, which is given by the lambda j, and then the proportion of the variance contributed by the principal component to the total variance is used as a weight for combining the principal components. But then each principal component is a very special linear combination of the dimension indexes. For example, the first principal component P1 will be something like A1 D1 plus A2 D2 plus A3 D3 plus A4 D4, and A1 A2 A3 A4 are very special weights that comes out from the principal component analysis. And similarly, we have B1s for P2, Cs for P3, and Es for P4. So now this is just a clarification. And then when you use this IFI from the equation 1 of the paper, we are actually making a linear combination of the principal components, which themselves are linear combinations of the dimensions. Okay, so we can collect the coefficients, and finally we come up with this equation 2, where we have we collected all the coefficients, lambdas and A's and B's and C's and D's, and then we come up with W1 D1 plus W2 D2, W3 D3, plus W4 D4, where I have just noted down the W1 and other W's also can be derived in this manner. And it's a very cool, simple way of aggregating dimension indexes into an index of financial inclusion. Now, I want to ask a very fundamental and basic, or maybe a big question, as to whether principal component analysis is appropriate for constructing an index of financial inclusion. The claim has been that the weights derived by using PCA method extract the maximum common information from individual variables or individual dimensions. However, in my view, the context is missing here, and therefore it may lead to a wrong usage of the methodology. The context here is that what is the information content that we are talking about? In principal component analysis, the weights of the linear combination of the variables, which are also known as principal components, are derived in such a manner that the variance of the linear combination is maximized. Therefore, the weights are derived in such a manner that the information content is in terms of variance covariance, which is the second moment, and not in terms of the level, which is the first moment or extent. So when we measure financial inclusion, we are necessarily concerned about the level of achievement or extent of achievement of various dimensions, and not about what is the variance of a particular dimension, or how different dimensions move together. So the variance covariance structure is not that important or relevant in constructing a development indicator like index of financial inclusion, because the information content is with respect to the second moment. Nevertheless, PCA is appropriate when we are concerned about the variance of the variance or the second moment is of interest. For example, if we want to construct a measure of risk of the financial system has got various sectors, the banking sector, the stock market, the exchange market, foreign exchange market, and then each segment is giving up some risk, and the risk is being measured by variance covariances and the co-movements. In that case, principal component analysis can be used to combine the risks coming out from different sectors, and an appropriate measure of risk can be defined in that manner. However, for indexes that are concerned about the first moment or the level, PCA does not have much intuition, I would say. So just to talk about the PCA problem, in the PCA problem, if we have a set of variables D1, D2, D3, D4, then we are trying to derive a vector A with components A1, A2, A3, A4, such that the variance of this principal component is maximized. And of course, we can have A1, A2, A3, A4 is equal to all put alpha, and then this that will solve our problem. Therefore, we have to put some structure in the weights A1, A2, A3, A4. So we make the norm of this particular vector equal to 1. So the variance covariance. So in this maximization problem, the variance covariance matrix of D1, D2, D3, D4, the underlying variables, plays a very important role in determining A1, A2, A3, and A4. And because the variance covariance matrices are very special matrices, they are symmetric, positive, semi-definite. Therefore, there are some nice theorems in matrix algebra which reduces this optimization problem into the problem of deriving eigenvalue and eigenvector of the variance Markov matrix. So it can be proved that the vector A here is nothing but an eigenvector corresponding to an eigenvalue of this variance covariance matrix. So with 4 variables, we have a 4-dimensional variance covariance matrix, and therefore we have 4 eigenvalues: lambda 1, lambda 2, lambda 3, lambda 4. Each eigenvalue generate an eigenvector of 4 elements, or dimension 1 by 4, which we can call A, B, C, D, A, B, C, E, and therefore we have 4 linear combinations. We can say that the first principal component is given by the eigenvector that corresponds to the highest eigenvalue, the lambda 1. And this lambda 1 is the maximum variance that we are trying to find in this optimization problem. And then we can come up with the second principal component, which gives the second maximum variance, and so on and so forth. So this is the principal component analysis PCA problem. Now coming to the practical problems that we may come across when we want to use principal component analysis for an index of financial inclusion is that the PCA does not guarantee monotonicity of the resultant index. For example, the weights of PCA need not yield a linear combination that is monotonic. By monotonic, I mean higher value of a dimension should lead to higher value of the linear combination. That might not happen, and I have created a hypothetical example to show you this. And second practical problem that we may bump into is that we may have because we are using the variance covariance matrix, which is the most important component of PCA, and the variance covariance matrix comes from the data, the weights become completely data driven, and therefore the weights could change for simple reason like addition of a few more countries in the data set or addition of a few more years of data in the set. And therefore, we cannot, since the weights are changing, so IFI value for this particular set, this particular year may not be comparable with IFI values for another year. And therefore, I would like to say that the weights derived from the PCA approach do not have much intuitive meaning. So as I said, I created a hypothetical example to show the lack of monotonicity, and I have the 4 dimensions. here is the variance covariance matrix of the dimension indexes, and the diagonal elements of this matrix gives the variance of each dimension, while the off diagonal elements give the covariance of pairwise dimensions, a pair of dimensions. So using this variance covariance matrix, I found the eigenvalues and corresponding eigenvectors, and these are my eigenvalues, these are my eigenvectors. And in many papers that use principal component analysis, they're just satisfied with the first, they just use the first principal component. But in this paper, the authors have used all the principal components weighted by the factor loading. And if we want to use this formulation, the weights W1, W2, W3, W4 for this particular variance covariance matrix is coming out to be minus 0.008, minus 0.005, 0.4, 0.392. Now these weights, W1, which is the first dimension, is weighted negatively in this particular example. And the second dimension also is weighted with a negative sign. Third dimension and fourth dimension are weighted with 0.4 and 0.39. Now with this dimension indexes, so it doesn't imply monotonicity. So if I have 4 hypothetical countries with me with dimension indexes, in the first given here, the first country is doing very well in all the dimensions with ranks or average percentile ranks 99.9, 89.5, 85, and 60 respectively. The IFI is coming out to be 56.28 by using these weights. And similarly, the second hypothetical country is doing well, doing as good as first country in dimension 2, 3, and 4, but not very good with dimension 1. But because of the lack of monotonicity, I am seeing that the IFI for country 2 is almost the same, or in fact a little bit higher than IFI for country 1. For country 3, the country 3 is doing equally well in dimension 2, 3, and 4, but very poorly in dimension 1, while in country 4 is doing very poorly in dimension 1 and 2, but equally well in 3 and 4. And their IFI values are coming out to be higher than the countries which are doing better. So that is one problem with the weights coming out from PCA. And the second problem, as I mentioned, is the lack of inherent stability. So if I add, suppose I add more data, many more countries, and therefore the variance covariance structures now have changed to different values. And then I use the same formulation and I get different weights this time. And with using these different weights, this time all the weights are coming out to be positive, but the second dimension is getting just a 0 weight. But that means how much ever well you do in the second dimension, it is not in fact getting captured in the overall financial index of financial inclusion. So in this case, I have some completely different, for the same set of countries, completely different IFIs. So these are my comments with the use of PCA. Maybe I did not understand very well. I have seen the weights of weights used by these authors, but I do not, though they're very nice. So I need a little bit more clarification on how these weights are derived. And then other comments would be on the dimension indicators. For example, some of the indicators can be used as, for example, I mean, the ease of getting credit or ease of credit information index has been used as indicator for financial development. I would say that we can have a new dimension called quality dimension, because when I saw this, the definitions of these variables, they actually indicate some quality of financial sector or financial inclusiveness. So we can have a quality dimension and not a financial development dimension. Similarly, deposit to GDP can be clubbed with usage, and bank concentration can impact financial inclusion, but it does not indicate financial inclusion. So we should not have anything that does not measure inclusiveness. For example, if I have a destination A and I want to reach the destination, the index should measure how far I have reached, how closer I have reached to the destination, and not how I have reached there. Whether I have taken a bus or a car or a bicycle should not be a factor in the computation of the index itself. Similarly, financial infrastructure like broadband, mobile phone subscription, internet connectivity, etc., surely impact financial inclusion, but they do not necessarily indicate financial inclusion. In our country, we have many people with mobile phones, but they do not have any bank account. They may be using their mobile phones to do some informal business or some catering services and all those things, and therefore use of mobile infrastructure or infrastructure will have an important positive association with poverty reduction, but not necessarily with financial inclusion. And the usage of electronic, digital mode, etc., is, in my view, just another way of financial system. So we could club them with the usage dimension. All I mean to say is that financial fintech infrastructure, fintech is another form of financial service. So as long as people have some financial service, they should be considered as financially inclusive. And so in my view, fintech infrastructure should come as a regressor in determinants of financial inclusion and not included as part of the index itself. So other comments on the use of index of effective financial inclusion, I think it's a very interesting idea to have an effective financial inclusion. But when you are computing your effective financial inclusion, there may be issues of endogeneity. And for example, in equation 3, where you're regressing IFI on different country-specific variables, one of the variable is collateral constraint, which is likely to be correlated with poverty, which is excluded from this regression. And therefore, and similarly, interest rate differential will be correlated with banking competition, which is measured by bank concentration ratio in your paper. And this has found place in financial development dimension in the IFI. So there is kind of reverse causality happening here. And in addition to that, IFI and GDP per capita may be behaving in a simultaneous or bidirectional relationship, each one impacting the other one. And therefore, these are sources of endogeneity, and you need a simple OLS regression will not give you necessarily unbiased coefficient estimators. So you need to perhaps use simultaneous equation model or instrumental variable models, etc. Further, the IFI value lies between 0 to 100, and therefore it is a truncated variable. So OLS will not generate biased estimator. A more appropriate method like Tobit regression should be used. But then those Tobit regression marginal impacts don't have any intuitive meaning. So I would say that it's better to use the actual IFI, which is computed by using a sound methodology and appropriate dimension indicators, and use that IFI to check for its association with socioeconomic indicators. So that's my comment, and thank you very much.
Thank you, Mandira. Perhaps Roger can quickly respond to these two comments before.
Yes. Okay. Thank you very much. In terms of the use of principal component analysis, indeed we considered, we use that as to form a linear combination and to generate some weights for the different dimensions. But when we did the weights, and which we showed in the paper, the weights are roughly equal to one another. There are very small differences across these weights. So the suggestion of also just of using a simple average for these different weights is an alternative where we can explore and to rerun the results for the paper. So in a way, we can do a robustness checks just using simple averages of this dimension, and that somehow does away with the problems that can be associated that are associated with the use of principal component analysis. And given my hunch is that given the weights that we generate are roughly equal to one another, which Sinyang and I have actually also discussed, it appears that we would more or less arrive with same baseline results as we have presented in terms of the impact of financial inclusion on socioeconomic outcomes. So thank you very much for that extensive discussion and clarification on what could be some of the caveats of using principal component analysis in in aggregating different indicators into weights. In terms of which also a question that or concern that Peter has raised on endogeneity, well, we tried so much to address that in different estimation by using instrument variable. So in a way, we ended up with using, of course, lag regressors as one solution. Yeah, we are not addressing those endogeneity, particularly for macroeconomic variables such as the one that we have been using. It's proven a bit of a challenge. So any further suggestions and comments on that would greatly help us in addressing that. In terms of the different classification of according to the different usage, we are considering whether this indicator would actually fall in this specific dimension. But Professor Mandira has actually pointed out a very important caveat that we don't necessarily just look into its contribution to, let's say, fintech infrastructure, but it also has to be related to financial inclusion itself. So that is something that we would, it's very important for us to actually consider that, yes, it may be related to, let's say, fintech infrastructure, let's say bank concentration, or in terms of financial development, bank concentration, but is this actually related more to financial inclusion itself? So that kind of mutual exclusivity between these variables is something that we should actually consider in order to improve our indicator moving forward. So with that, thank you very much for those two comments on endogeneity, on the use of PCA, as well as going through some of the indicators to see how they are still related to financial inclusion. So those are my comments, Inyang.
Okay, thank you. In fact, we've had quite a lot of discussions also in terms of how to avoid the endogeneity, and I actually did have some concerns of the reverse causality. But in terms of using so many different indicators for different dimensions, I think our motivation was more of creating a very comprehensive measure. Like, and then it's very difficult to narrowly define what is the financial inclusion. And I actually feel that everybody has a different ideas of the financial inclusion. Some may feel that like having certain deposit is excess, or some it can be usage. Yeah, but I don't see a very clear cut, like what defines the usage, what defines excess. Actually, so either you create just one simple kind of composite index, including all indicators, or try to have a bit of a different sort of group of indicators to make it a bit, I guess, a measure to be able to discuss policies, like how they can be related to the policies, what can be related to policies. So I do agree. The indicators we use are more or less like a determinants or like a factors. And then, as I earlier mentioned, that I do feel that financial inclusion really is at the end of the day, kind of outcome of a lot of different factors, complex factors, and then the policy measures. That's where we were sort of gathering all different factors that can be that can be definitely interpreted as factors or elements, policy elements that might lead to the financial inclusion. And that's also the idea behind the effective financial inclusion indicator, because I frankly don't believe that financial like just because you somehow introduce the M-Pesa, just one tool, that's going to create like a miraculously high financial inclusion, and then that's going to make such a big difference in our country. Because what you introduce as a one policy measure will show a very different effectiveness in the end, depending on the the country context. So some countries having one innovative the digital tool can actually lead to certain effective financial inclusion. In some countries, that digital tool may not really lead to effective policy, effective kind of financial inclusion. So that's what we were trying to capture. But I do appreciate the challenges of using the PCA. Also the there are still the complications of the indigeneities, and then also the reverse causality issues in using multiple sort of determinants of variable, and then also using the fitted value of these determinants variable for assessing the policy impact. So I think there's a lot more questions again that we need to answer. So but I actually want to maybe discuss a bit different aspects of these financial inclusion as well. Like I know Peter has written quite a bit on the impact of financial inclusion and financial stability. What were the major findings of these studies, and do you feel that the financial inclusion matter for financial stability? If so, why and how?
Yes, thanks very much. Yeah, I think there's been a debate for some time about what's the relationship between financial inclusion and financial stability, because I think the sort of traditional view was that if you extend credit to less creditworthy borrowers, which presumably small and medium firms, for example, are, then aren't you increasing the risks of financial instability? I think that was certainly, the obvious example of that is the subprime crisis in the U.S. But I think there are some opposite arguments too, which are that small firms have different risk characteristics than large firms. The large firms tend to have the sort of fat tail risks, whereas that's not true of the smaller firms. And because you have different risk characteristics, you would gain some advantages in terms of overall risk performance of your portfolio by including different kinds of assets in the bank's portfolio. So what we did was to look at the share of loans to SMEs in overall bank lending, looking at data in a number of different countries, and then we had two measures of financial stability. One was the country level Z-score, which is a measure of the probability of the average bank going bankrupt, and also the NPL ratios. And we found in both cases that there was a positive relationship, that is the share of lending to SMEs actually was positively correlated with the measures of financial stability. That is either corresponded to a higher Z ratio or a lower NPL ratio. So I think that was some interesting findings, and that paper has actually been cited quite a bit. That's my most cited paper. But we also looked at mortgage lending, and again, comparing the share of mortgage lending in total lending, and this was at the bank level, not at the national level, over time with, again, these two measures of the Z-score and the NPL ratio. And what we found there was kind of interesting. It was actually a nonlinear relationship, so that up to a certain point, you had the diversification benefits, and so you had a positive effect of the share of mortgage lending on the risk measures. But beyond a certain point, the effect turned a negative, because presumably you were moving from a diversification benefit to a concentration risk. So that suggests that financial inclusion may have some limits that you do want to be concerned about risk concentration.
Okay. Well, I think in our paper, we focused a lot also the country context and then the level of the financial development, because I was also very much of, intrigued by the role of, or like influence of the financial development for financial inclusion. And, in your paper, like in the context of the linkage between the financial inclusion and the financial, the stability, like what will be sort of underlying conditions for the country that somehow influence the effect of financial inclusion on the financial stability? Like, do you feel that there is a certain threshold of the financial development in a country that can still pursue financial inclusion without leading to a certain instability in financial markets?
Well, we didn't see any particular threshold level there. I think that the asset diversification effect should operate pretty much independent of the level of financial development. And of course, you've had some very advanced countries, very highly developed, highly financially developed countries like my own getting into trouble, so that there's no guarantee that higher financial development per se is going to reduce potential risks associated with financial inclusion.
Okay. Turning to Mandira, you've done quite a pioneering work on the measurement of financial inclusion. You introduced a multidimensional sort of approach to measure financial inclusion. Can you elaborate on the different dimensions of financial inclusion and then why you feel that they are important in the measurement of financial inclusion?
Thank you, Ms. Park. Yes, I think financial inclusion is multidimensional because precisely because I agree that financial inclusion has to be effective. So some people long time back used just the number of people or proportion of people having a bank account as a measure of financial inclusion. But that does not necessarily imply that people are using their bank account, or they are able to use if they do not have a bank branch, or if they do not have internet facilities to use the bank account, the inclusion is not effective. Similarly, if they do not understand, if they do not have literacy about various financial products, they would not use their bank account. So there are several papers, several survey-based papers based in many African countries, as well as based in some developed countries like the USA, where low-income people having a bank account or any other alternative form of financial system were not using their bank account. Instead, they were using informal sources for borrowing and savings, because they did not, those products were not either not relevant for them, or they had some fear for using those facilities or whatever. So their inclusiveness was not effective. And therefore, I thought that along with financial sector penetration, if you have a dimension for availability of financial services, in terms of digital platforms, in terms of internet banking, in terms of physical outlets like bank branches and ATMs, or in terms of even mobile money service providers. That could indicate some amount of availability of financial systems. And the third dimension that I used in my earlier work was to do with the usage, how much of the banking system or the financial system has been used. At that time, we did not have a lot of data. So I just proxied the usage dimension by the volume of deposit mobilized by the banking sector, volume of credit mobilized by the banking sector, all as proportion to the GDP of a country. But now we have a lot more data. We have even data on how many times a person has used the bank account for borrowing or saving, or how many times a person has used credit card or transaction. All those data are there, and we can fit all those data into these broad dimensions to measure a good index of financial inclusion, which will include not only financial sector penetration, but also accessible usage and availability, all of them. So that will make, so using several dimensions would make your index an effective index of financial inclusion, in my view. Yeah.
Okay. Well, with kind of like arrival of the digital solutions now, there are a lot of new, I guess, indicators that can suggest, some that can suggest like how we can improve financial inclusion, right? But at the same time, there are a lot of challenges in use of digital technology for financial inclusion, like for example, like a lack of the digital ID and also the digital divide. And what do you feel that is the biggest challenges of for developing and then emerging economies in using these digital sort of solutions for achieving inclusive growth?
Yeah, it's a very interesting question. So I think financial inclusion is not an end by itself. It is a means to achieve developmental targets. But then developing and emerging economies have so many structural issues in terms of poverty, inequality, illiteracy, health outcomes. So very often the infrastructure that is built for a particular purpose does not get utilized because of lack of capabilities. So I would say that financial inclusion policies like fintech infrastructure or other digital infrastructure should be accompanied with other policies that addresses the basic structural problems of the economy in emerging and developing economies. So the challenge is to uplift the capabilities of people so that they can use the infrastructure. So I think the biggest challenge is to go hand in hand with other policies that address structural issues that plague many emerging and developing economies like ours.
We use a lot of measures, but there are, policies, they often sort of set to promote financial inclusion, such as having maybe a national financial inclusion strategies and having like a digital payment system, diversifying financial services, and like based on our discussion, do you feel that there are certain measures or certain dimensions of financial inclusion we need to include to understand the effective financial inclusion better? Or is what sort of measures that do you suggest that Asian policymakers need to focus more?
Well, it's quite a difficult question because the idea is to understand what we are trying to do. We are trying to include more and more people in the financial system so that they can benefit from the financial services. But then financial system is just an intermediary towards economic development and economic progress. So if we, yes, financial inclusion is a very big problem in developing economies, and policymakers have put in a lot of effort in bringing in or promoting financial inclusion, and there have been lots of measures in my country, like Jan Dhan account, whereby banks are supposed to give no frills, basic banking account to anybody, all poor people, and whereby also the policy, there is a policy which says that poor people who are working under the National Rural Employment Guarantee Program should be only paid to their banking account and not in cash. And these are the policies that have been taken, that had been promoted or that had been put in place. However, as I said, effectively, the people for whom these policies are implemented or designed for, if they do not understand. For example, I remember an anecdotal story told by my colleagues who were doing some survey work in a very remote village in some part of central India. And those people were employed for the National Employment Guarantee Program, which is a program in which infrastructures are built up using local manual laborers, so that local people, local villagers get some employment and some income or livelihood. So the nice policy that these people have to be paid only in a bank account was implemented by the contractor, but the people did not know that they actually have a bank account. So when they were enrolled for the employment guarantee program, they were made to fill some forms, or the forms were filled because they are illiterate, they do not know how to fill. Forms were filled by the contractor himself, and their signatures were taken, and bank accounts were opened for these people, and the payment which is made by the government were made to the bank accounts, but the nearest bank branch is about 30 kilometers away. So villagers don't have any bank account, and at the moment they don't even know that they have a bank account. And what is done is the contractor goes to the bank, uses the ATM cards of the account holders, and withdraws the money and pays them in cash. So on paper, all these 300 people who are enrolled for the employment guarantee program are financially included without their knowledge, because they do not understand what it is. They're only concerned about the livelihood and the amount of income that they are going to receive. So they're all financially included, and their account is being used by their contractor. And at the end of it, maybe the contractor is not even paying them what is due to them, because he's finally making the payment in cash. This is an anecdotal story. I do not know it's a problem, but I do not know how widespread this problem is. I'm hoping that it's not a widespread problem, but just a one single incident. But it is possible that we have this kind of issues. So all I'm saying is that the empowerment of people is equally important while promoting financial inclusion policies, because we live in a holistic, we have to look at it from a holistic point of view of development.
Thank you. Peter, I know you have done quite a lot of work on the use of digital solutions and then fintech for financial inclusion. And we witnessed actually increased use of fintech during the COVID pandemic. Especially a lot of the kind of mobile apps and the really like a contactless sort of the technology. Do you see an increasing role of fintech in promoting financial inclusion, and what challenges and opportunities that facing Asia in terms of using these fintech and digital solutions for financial inclusion, and how does it also imply for financial stability?
Yes, well, I think fintech certainly has a potential to increase financial inclusion, and the thing that everybody points to is the wide diffusion of mobile phones and increasingly smartphones, which can be a platform for financial inclusion. However, you still need the rest of the infrastructure to support that. So, for example, if those people who have a smartphone don't have a bank account, which is still very much the case in many Asian countries, you have to have an alternative system which can essentially get the cash in and out of that smartphone. So that the other obvious candidate is what's called agent banking, which means that the local convenience store or sari-sari shop actually essentially acts as an ATM, where the shop manager will essentially do the transactions to get the cash in and out of the person's phone, so that you need that infrastructure. You have to have registration of the agents. You have to have some kind of monitoring of them. I mean, again, there are various anecdotes where, let's say, people have PIN codes for their other accounts, but the agent gives the same PIN code to everybody who comes to a shop. So, the degree of security is actually quite limited. So I think it's a multidimensional process. Education is also very important. Now, in addition to financial literacy, you also need a digital financial literacy, which is basically knowledge about fintech products, including the risks of those products. What happens if something goes wrong? How do you get redress? You need digital literacy to be able to manage the transactions and protect your identity, that kind of thing, so that it does have potential, but it's not necessarily easy. And I think also what we find is that if you look at who adopts fintech, it's basically those people from the perspective of financial inclusion who need it least. It's the higher income people, the more educated people. So you're still probably the incremental effect on the unbanked is still probably rather limited.
Okay, thank you. Well, in our paper, the one thing that I felt quite interesting was the finding that the effect of financial inclusion on poverty, especially also like the women's empowerment, can be quite different depending on the level of country development, like economic development. So there seems to be a non-linear effect of financial inclusion in terms of maybe the Asia Pacific have a wide-ranging countries that have a different level of economic development. So in terms of let's say Asia Pacific, like for developing, especially the low-income developing countries, what sort of the policies and measures that you would suggest, or like do you even agree, like in terms of having this type of non-linear effect of financial inclusion? If the non-linear effect of financial inclusion holds true, then what would be the right way of policy responses?
Well, I think you would probably do a lot more sort of sensitivity analysis on the effects of the various components. I mean, you've basically got one set of indices there. It would be interesting to see how robust the results are to maybe different permutations of that index. And then if you get a very consistent result, then I think that could lead to some interesting policy implications.
Okay, and Mandira?
I don't have a very strong opinion about using the functional form of the relationship, because the functional form of the relationship gives us an idea from academic point of view and even for policymakers' point of view that there is an impact. And because there is an impact of financial inclusion on poverty, which may be non-linear, so every nonlinear relationship can be approximated by a linear relationship, I think, mathematically speaking. So the policymakers should put in place policies to improve financial inclusion, and thereby which will impact poverty and the non-linearity in the impact will take place over time. So I think the mathematical functional forms, etc., in real world will not really make much relevance for policymakers. Your policymakers' job is to promote important policy or effective or impactful policy that can impact the developmental outcomes in a more effective manner.
Well, let me rephrase a little, because I do feel that this is very important actually, because the policies are always about trade-off, right? Where the low-income countries, you have a higher effect of financial inclusion on poverty reduction compared to the high-income countries where the financial inclusion doesn't really have that much of a high marginal sort of effect. Then it's actually costlier to pursue financial inclusion measures compared to other financial measures in terms of improving the welfare in the economy. I wonder, like, if you have any thoughts.
Yeah, so if I can add my little thought. When we are talking in terms of policies, we have, each country has its own policy maker. So we look at the world, we look at countries, income group specific countries, and we can say, okay, our experience matches with the low income countries' experiences. So accordingly, we should try to build up our policies. And in addition to that, we should have our own country specific studies also. Maybe based on field work or maybe based on other pilot surveys, we should have some specific policy measures that would be beneficial for our country, because each country eventually has its own structural bottlenecks, which are very different for different countries. So when we are talking in terms of policy, it should be country specific.
Yes, I would agree that it should be the policies will have to be country specific, because they're done by the local policymakers anyway, and they have their own appreciation of the local circumstances. So I think these kind of results can be an input into their decision making, but it's not necessarily going to be the main factor.
Okay. Based on all these discussion, I wonder, like, if Roger has any further thoughts in terms of, the improving the financial inclusion measure, and then also the use of that index for policymakers.
Yes, so in terms of the index, I think, more, additional work needs to be done in terms of identifying some of the indicators that not only reflects a particular dimension, but as Professor Sarma mentioned, that would also somehow relates to financial inclusion itself. So that's one area that needs to be done. Another area that I'm actually thinking of is that what are some of the impact already of some of these policy measures that try to target financial inclusion? How effective are these policy measures taking place? So, for instance, there could be some countries that already implemented some digital platform in terms to increase financial inclusion. I guess the next step would be to understand, how this is actually impact poverty and all other socioeconomic outcomes that we have been studying for quite some time now. So the move. What I'm thinking is, like, the next step would be more to look into the national policies that different officials have implemented in their own level, in their own national economies, and then assess whether how these policies have become more effective in deriving some socioeconomic or improving economic outcomes. So that's my 2 cents on additional future work on this, policy perspective. Yes.
Okay, well, thank you very much for active participation, and also really thank you, Sarma, Professor Sarma, for really thorough review and then excellent suggestions for the measurement, and also Peter for sharing the insights on the financial inclusion and financial stability. So thank you for all to have participated today's discussion, and we look forward to seeing you in the next RCI-POD webinar. Thank you.
Okay,
Thank you
thank
very
you.
much. Thank you, Joe. Thank you.
Bye. Thank you.
Bye-bye.
Thank you.